Hi, I'm Len. Welcome to Financial Lens, the impact of the Biden presidency on your finances. Just wanted to say up front, this is not a political discussion. This is not designed to discuss political views, compare presidents, compare presidential candidates. It's designed to look at where we are in our current state of the economy, take a look at economic conditions, how they affect the stock market, take a look at tax policies and interest rates, and conclude with what we should be thinking about now for our finances, how we can improve them to get the best results. I want to first talk about where we are as far as our economic world. As we all know, we're in this pandemic. Of course, many people have gotten very ill. Many people have lost their lives. And so the medical and the life aspects of this are a big, big concern. But we're going to focus on just how this has affected the economy. Of course, some people have lost their jobs because their industries were shut down or they were impacted in other adverse ways related to work. Some people have continued to work. Maybe their jobs were not affected, or maybe they were receiving retirement income that wasn't affected, but their spending behavior, the spending patterns have changed. And as a result, GDP, the gross domestic product, which is a measure of manufacturing and service offerings in this country, has been reduced significantly. Now, the stock market has taken a big lost about 35%, and it recovered and then some, and the market is valued as if things are going to be fine and what we experienced was a temporary setback. And we want to look at the possibility that this pandemic might just be a disruptor of the economy versus a changer. That's what the markets are viewing this as being a temporary disruptor. The markets right now are in a very, very strong position in terms of valuation. The market had a valuation 10% higher than it was expected to be at the end of the year 2019. It was expected to increase by about 10% and it grew by about 20%. And the market is actually about 10% higher now than it was prior to the pandemic started. So in some ways we can say maybe the market is overvalued, but valuations based on long-term projections do not appear to bear that out. We do want to look at an interesting measure, which is the price-earnings ratio. The U.S. price-earnings ratio is about 22.5. The price-earnings ratio for developing countries and emerging markets is about 17.5 and about 15 times earnings. The U.S. market is overvalued compared to historic measures. However, we have to look at the earnings are down, perhaps temporarily, and the prices are looking at a further down the road view. We also want to take a look at something called the Shiller Index, which is a cyclically adjusted price-earnings ratio referred to as CAPE. And what that does is looks at the quarterly earnings of corporations over the last 10 years, and it averages them divided by the current price of the stock. So what it does, it looks at the long-term earnings of the stock compared to the current price. What we try to do is look to see if we are in a longer-term valuation or undervaluation of the stock. Right now, the index is at the second highest level it's been at all time. It's at a second all-time high level, the highest time being the stock market crash and the tech bubble burst. As we all know, the stock market lost 50% over a 3-year period and took quite a while to recover. There are two things that can happen with a high CAPE, a Shiller ratio. One is we could have a stock market crash. We could have the beginning of another bear market, or another possibility, the one that seems more likely, is that we'll have reduced earnings. The stock market historically has gained 8 to 10%. Most economists feel that the stock market will outperform bonds by about 3 to 5%. And given that the bond returns will be about 1 to maybe 2%, it can be safe to project that the stock market might grow someplace in the neighborhood of 5 to 6.5% over the next 10 years without fees taken into account. So certainly we're going to be in a lower growth opportunity for the stock market based on current valuations. So in some ways, there's very little that the Biden presidency can do to accelerate the stock market. It's really the best opportunity that I think that the presidency can do is try to stabilize the economy and keep it from tumbling. How can they do that? Well, one, we're looking to see how they can stimulate the economy. We're looking at the potential of stimulus checks to boost the economy by providing additional resources for people who maybe had a downturn in their economic situation, maybe have lost their jobs and have a hard time paying their bills. So that stimulus will help. But the bigger opportunity really is for the government to really get this virus behind us. That will require government spending to get vaccines manufactured and distributed. If in fact the government will be involved in the manufacturing phase of it, certainly get it distributed. And really from an economic standpoint, what we're trying to do is to accelerate the speed to which things return to normal. The longer it takes to return to normal, the greater likelihood that they will not return to normal and will have some permanent long-term downturns. We also want to look at the interest rate environment. So we want to look at where we are currently. The interest rates are at a historically low level, or they have been just fairly recently at a historically low level. The 10-year Treasury, which really drives a lot of value interest rates in the marketplace, is just over 1%. Historically, it's much higher than that. Historically, it's closer to 3 to 4%, but it's about 1%, and that has some good and bad news. The good news is that low interest rates help the marketplace, the stock markets, because lower interest rates means that companies can manufacture and can build out a little bit more cost effectively. They can borrow at lower interest rates. They can invest in their businesses, and they can push out product more easily. The bad news is that there are some folks who really rely on those interest rates to get returns, to retire on. When we have a low interest rate, that's good for the markets, but it's bad for the returns of those vehicles. The interest rates have crept up a little bit. The Trump presidency had tried to depress those interest rates during an election year to try and help stimulate the economy. And we believe that the interest rates will creep up a little bit this year. That's really not a reflection on the Biden presidency. And if they were to creep up a little bit, the general consensus is that it would not be a bad thing. The biggest thing we want to really look at with the Biden presidency, however, is taxes. We had the Tax Cuts and Jobs Act of 2017 passed under the Trump administration. And there are a few things that happened with that tax legislation. One is the tax brackets for consumers across the board were pretty much reduced by 3%. Also, we had the corporate tax structure reduced, where corporations were paying essentially 35% tax. That was reduced down to 21%. There's a question whether that might be increased. I have not heard that that's a possibility, but if the corporate tax is increased, that would tend to have a negative impact on the stock market. We also have personal income taxes. They were reduced pretty much 3% across the board. When people have less tax, they can spend more, and that drives the economy, so that does certainly help. But the bigger impact is strictly for individuals, that they are taxed more or they're taxed less. And that can, of course, impact their spending. It could impact their ability to save. So we believe that the tax rates of individuals would potentially be a big impact on personal finances that the Biden presidency can affect. From what we understand, the tax increases would probably be on higher wealth individuals, not under the middle class American tax brackets, but that is yet to be seen. The other government policies related to taxes are related to estate tax. Part of the Tax Cuts and Jobs Act were to increase the threshold above which people would pay estate tax, or said another way, to increase the threshold under which people would not pay taxes. So under the current law, we have individual tax ceiling of $11.5 million and a joint couple of $23 million. So couples who have less than $23 million would not have to pay, or their estates would not have to pay estate tax. There's talks that might be reduced to 3.5 per person and $7 million. That's still a lot of money, but that would put a lot more people into that estate tax category and might create an opportunity or a need to do more estate planning, which quite frankly has been set aside for most folks. Another aspect that might be changed is there's something called a step up in cost basis when people pass away. And what that means is if someone who is living purchased or acquired some kind of investment at a certain price, and that value of that asset increased over time, if they were to sell that, they would have to pay tax on that gain if they were to sell it. Under the current legislation, when they pass, that starting value, called the cost basis, is deemed to increase to the current market value. So when an heir inherits the money, they do not have to pay the tax upon the death of the individual. They would only pay that tax to the extent it increases after the death of the individual. There's talk that capital gain, the step up in the cost basis, may be done away with, which would have a potential very big increase and very big effect on individuals for heirs. So when we look at what the Biden presidency can do, they can certainly maintain that best case scenario for the economy by the government policies of spending. They can perhaps impact interest rates. We don't see that that's a big part of this equation. But the taxes are the big unknown that can truly affect Americans. So we ask you to look at our video, the financial strategies for right now, that will give you some specific ideas what you can do. And a few of them are, take a look at your exposure to the stock market. Maybe you're overexposed. Maybe the potential returns compared to the risk is not to your liking compared to a historic amount of returns for the amount of risk you're taking. Take a look at your interest rate opportunities. Right now, the bond rates are paying very low interest rates. You'll see how you might be able to get a better outcome by potentially converting some of your investments to annuities. We also suggest that you look at opportunities to do Roth conversions, to take IRAs, convert them to a Roth IRA at potentially a lower tax bracket, a more favorable tax bracket. However, we don't advise that you do Roth conversions at this time until we have a little bit better idea what the Biden administration will be proposing for the taxes and what will be actually the tax brackets for this year. And of course, there's the estate planning opportunities. If you have a large estate, you want to consider strategies to reduce that. And if you have a step in cost basis opportunity that might have withered because the government is reducing that opportunity for that step up in cost basis, that is something that we do not know yet about. You might want to consider funding the taxes for that with life insurance or perhaps other strategies so that assets that you leave to your heirs that you would want them to keep and that they would want to keep would not have such a high tax obligation that will require them to liquidate that asset. And we're talking particularly about properties, maybe second residences, maybe vacation homes, maybe farms, that capital gains on that inheritance could cause people to liquidate that asset. So thanks so much for watching. We appreciate your attention. We look forward to being of service to you. And we'll just offer again the financial strategies for right now video to take a closer look at some of the opportunities to take advantage of the current market situation to put yourself in the best light. Thanks for joining us at Financial Lens.